closing bell, starting to get some headlines in connection with this speech that we are about to hear from Fed Chair Jay Powell. Jay Powell, in these remarks released ahead of that speech, inflation heading toward 2% on a sometimes bumpy path. We can approach decisions carefully amid a strong economy, and the economy not signaling a need for the Fed to hurry rate cuts, which is kind of interesting considering we've got just, one more meeting to go before we wrap up 2024. We've got a December meeting. Traders expecting a rate cut, but maybe that's not the case.
Yeah, these are prepared remarks that we expect to hear from Fed Chair Jay Powell in just a few minutes in Dallas when he gets started. But we got a little preview of him, and here's what he says. Quote, "The strength we are currently seeing in the economy gives us the ability to approach our decisions carefully." Remember, U.S. central bankers began lowering borrowing costs back in September, that aggressive half-point rate cut, and then lowered that rate again by a quarter point last week. We'll see what happens come December.
Just want to mention, I'm looking at the 2-year right now, moving up here in terms of the yield, 431. So we've definitely seen a bump up. 5-year just a little bit higher as well on those Jay Powell remarks, 431. And if I look at the longer end, the 10-year specifically, we're looking at a yield of about 442. We've been bouncing around a bit today. We did get an inflation read, PPI earlier today. But again, very interesting to say that inflation heading toward 2% on a sometimes bumpy path, which means can go up, can come down, but it makes it kind of tough to figure out where it's going to land, is my read on that. And then I think what's really key is that Jay Powell saying the economy not signaling a need for the Federal Reserve to hurry those rate cuts, and that's why you're seeing a tick up all along the U.S. Treasury curve.
Well, in just a minute, we're going to go live to Fed Chair Jerome Powell. A speech and a Q&A in Dallas, Texas, set to start in just a few minutes. I see introductory remarks being given right now. We'll bring his comments to you live as soon as they air. And also, Jamie Dimon speaking to our own Lisa Abramowitz down in Peru right now.
Yeah, super important voice, too, on the economy, on the financial system, on the credit picture, if you will. He is sitting down with Lisa Abramowitz, so we're going to hear a little bit later on from that conversation as well. And then we're going to finish up with some lighter fare on Martha Stewart. There's a new documentary, in case you missed it, so we're going to get into that in just a moment. But I do want to get to a story as we await Jay Powell to get up on the stage. We're going to just kind of continue monitoring. In the meantime, quick check on that trade. Here's Charlie Pellet.
Thank you very much. Quick check indeed with the S&P down 26 right now, 59.59 where we stand. We got 58 minutes to go ahead of the closing bell. Right now, the S&P down 0.4%. Dow Industrials down 0.3%. NASDAQ lower by 0.5. Your 10-year 4.42%. Your 2-year 4.31%. Gold down 0.1%, 25.70 the ounce. West Texas Intermediate crude up 0.3%, 68.66 for a barrel of WTI. And Bitcoin right now up 0.5%, 89,100 on Bitcoin. President-elect Donald Trump's transition team plans to kill the $7,500 consumer tax credit for EV purchases. That, according to Reuters, citing two sources. Tesla shares down 5.2%, Rivian down 12.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We are awaiting a speech and a Q&A with Fed Chair Jay Powell in Dallas. We'll take you there in just a moment. But in the meantime, we are on
Hello.
Right here and saying Fed Chair Jay Powell said the recent performance of the U.S. economy has been remarkably good, giving central bankers to lower interest rates at a careful pace. And right now, you're looking at a 2-year note that has really kicked up to its highs of the session now at 4.32. Looking at the longer end of the yield curve, we're looking at a 10-year at 4.43. So you're seeing a bit of a squeeze there along the yield curve.
Yeah, here's what Powell said in those prepared remarks, which we do expect to hear from him in just a few minutes. Quote, "The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we are currently seeing in the economy gives us the ability to approach our decisions carefully."
Yeah, I think this is key too. Inflation is running much closer to our 2% longer run goal, but it is not there yet. These are the words of Jay Powell in those prepared remarks. He went on to say, "We are committed to finishing the job with labor market conditions in rough balance and inflation expectations well anchored. I expect inflation to continue to come down toward our 2% objective, albeit on a sometimes bumpy path." So we are expecting to hear this when he steps up to that podium in Dallas.
Remember, data out earlier this week showed a measure of underlying U.S. inflation remaining firm in October. So-called core CPI is running much closer to our 2% longer run goal, but it's not there yet. We are committed to finishing the job with labor market conditions in rough balance and inflation expectations well anchored. I expect inflation to continue to come down toward our 2% objective, as you mentioned, albeit at a sometimes bumpy path.
Yeah, and on a day where we got, unemployment claims today, which came bang in line, and actually a little bit lighter in terms of those weekly jobless claims numbers. They did ease, but even this as further layoffs loom, as we reported out earlier today. Jay Powell on the labor market saying it has cooled but remains solid. So we'll look for some more nuances perhaps in how he characterizes. And I think what's going to be interesting is we are laying out pretty much what Jay Powell's going to say in his speech. You're getting kind of the main points, but it'll be interesting in that Q&A session whether or not he is pushed on, that inflation target, whether that 2% goal is actually achievable, how long it might take, and what's involved. And then if he's pushed a little bit more on holding off, does that mean a December rate cut is less likely? Because if you look at what's happening, certainly in the Treasury trade, you're definitely seeing yields move up all along the curve.
I'm still interested in politics.
Mic check, mic check, mic check. Let me just turn on the audio. Okay, you see now. Now I can hear the playback, so you guys should be able to hear me now. It might be even too loud. Let me listen on YouTube. Yeah, YouTube. Okay. What is going on with OBS? It's always on some BS. No, I'm playing, guys. Anyways, yeah, so we're waiting for the Fed to get on live. I've got Bloomberg in the background. If you guys need me to turn it up, just let me know. This is mainly a stream focusing on listening to what the Fed is saying, right? Let me just mute this. Listening to what the Fed is saying and using that information to have an educated discussion. However, also to understand the implications of what the Fed is saying. But right now, it is looking very positive in terms of some of the statements the news anchors have been saying at the moment. They're saying like inflation is coming down to 2%. I mean, who would have thought, eh? Which is incredibly positive for the dollar. Okay, there's just more and more positivity around the dollar at the moment. So I don't see how and why this should still slow down. The next area of liquidity for the dollar is going to be last year's high, which is crazy. We're taking out yearly highs here, guys. So yeah, for the time being, let's just take a look at what current price is doing. We might even be able to get into a bit of a short sell on the majors. Yeah, we might be able to, but you guys should be able to hear me now very, very clearly. Let me just turn this back on Bloomberg.
Rears its ugly head again, especially when you are facing an administration with a lot of pro-growth policies.
So that's what I want to talk about, and also not just pro-growth.
How's the background? Okay, guys. Yeah.
Tariffs. So if tariffs are indeed inflationary, and we do see that coming, then what does that mean for the Fed?
All right, to Dallas we go, and Fed Chair Jay Powell.
Journalism and is a 7-time Gerald Loeb Award finalist. She grew up in Florida and graduated Phi Beta Kappa from.
So looking back, the U.S. economy has weathered
just about got there, guys.
In its aftermath.
He literally just started speaking.
To a good place. The economy has made significant progress toward our dual mandate goals of maximum employment and stable prices. The labor market remains in solid condition. Inflation has eased substantially from its peak.
Do you guys want me
and
to
we believe
increase
it is on a sustainable path
the
to our
Fed's audio?
2% goal.
How does it sound? Let me just text it.
We are committed to maintaining our economy's strength by returning inflation to our goal while supporting maximum employment. The recent performance of our economy has been remarkably good, by far the best of any major economy in the world. Economic output grew by more than 3% last year and is expanding at a stout 2.5% rate so far this year. Growth in consumer spending has remained strong, supported by increases in disposable income and solid household balance sheets. Business investment in equipment and intangibles has accelerated over the past year. In contrast, activity in the housing sector has been weak. Improving supply conditions have supported this strong performance of the economy. The labor force has expanded rapidly, and productivity has grown faster over the past 5 years than its pace in the two decades before the pandemic, increasing the productive capacity of the economy and allowing rapid economic growth without overheating. The labor market remains in solid condition, having cooled off from the significantly overheated conditions of a couple of years ago, and is now, by many metrics, back to more normal levels that are consistent with our employment mandate. The number of job openings is now just slightly above the number of unemployed Americans seeking work.
That's positive.
The rate at which workers quit their jobs is below the pre-pandemic pace after touching historic highs 2 years ago.
That's positive.
Wages are still increasing, but at a more sustainable pace.
So I'm looking
hiring
at this
has slowed
potential
from
setup here,
earlier in
guys.
the year. The most recent jobs report for October reflected significant effects from hurricanes and labor strikes, making it difficult to get a clear signal. Finally, at 4.1%, the unemployment rate is notably higher than a year ago, but has flattened out in recent months and remains historically low. Turning to inflation, the labor market has cooled to the point where it is no longer a source of significant inflationary pressures. This cooling and the substantial improvement in broader supply conditions have brought inflation down significantly over the past 2 years from its mid-2022 peak above 7%. Progress on inflation has been broad-based. Estimates based on the Consumer Price Index and other data released this week indicate that total PCE prices rose 2.3% over the 12 months ending in October, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Core measures of goods and services inflation, excluding housing, fell rapidly over the past 2 years and have returned to rates closer to those consistent with our goals. We expect that these rates will continue to fluctuate in their recent ranges, and we're watching carefully to be sure that they do, however, just as we are closely tracking the gradual decline in housing services inflation, which has yet to fully normalize. Inflation is running much closer to our 2% goal, but it's not there yet, and we are committed to finishing the job. With labor market conditions in rough balance and inflation expectations well anchored, I expect inflation to continue to come down toward our 2% objective, albeit on a sometimes bumpy path. Given progress toward our inflation goal and the cooling of labor market conditions, last week my Federal Open Market Committee colleagues and I took another step in reducing the degree of policy restraint by lowering our policy interest rate by a 0.25 percentage point. We're confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%.
He said it.
We
He said
see
it,
risks
guys.
to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks to both sides. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. We're moving policy over time to a more normal setting, but the path for getting there.
He said that inflation is going to come down to 2%.
Considering additional adjustments to the target range for the federal
Let me
funds
turn it
rate,
up.
we will carefully assess incoming data, the evolving outlook, and the balance of risks. The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve. We remain resolute in our commitment to the dual mandate given to us by Congress: maximum employment and price stability. Our aim has been to return inflation to our objective without the kind of painful rise in unemployment that has often accompanied past efforts to bring down high inflation. That would be a highly desirable result for the communities, families, and businesses we serve. While the task is not complete, we've made a good deal of progress toward that outcome. Thank you very much, and I look forward to our discussion.
Okay, cool. So there you have it, guys. The statement's done. He's
Thank you,
pretty
Chair
much
Powell,
gonna
for those
answer
remarks.
some questions now, to do with what he has said. But so far, it's pretty positive at the moment. There's a lot of optimism surrounding the dollar at the moment. So we're most likely going to see the dollar continue to rise for the rest of the week, really. I think we're going to have a very strong weekly closure. So I am anticipating some potential short setups. But I do understand that, for gold at the moment, we've come into quite key areas where we can see a rise a lot higher. But for the time being, I've got a couple of setups there. I'm just monitoring price. We're going to monitor this potential short, and we're going to play it if it comes to us. Cool.
What that really means is that the decisions that we make about monetary policy, about interest rates, cannot be reversed by any
So
other part of
now
the government.
people are going
except,
to
of
ask him
course,
questions and
Congress.
he's going to answer
Congress
them, yeah?
created the Federal Reserve by statute and can do what it wishes to do by statute. But our decisions are not reviewable by any other agency. And we are charged to make those decisions with regard to the medium and longer term well-being of the public that we serve. So we're not thinking as we make our decisions about the well-being of any political party or anything like that. So we're just looking at the macroeconomics and doing the very best we can. There's been a lot of research about central bank independence, and what it shows is that central banks who are independent, meaning independent from the other parts of the government, do a better job on inflation. And that makes a lot of sense because we're thinking really just of getting inflation under control while keeping the labor market strong, and we're not thinking of political factors, which would frankly be a distraction to the already difficult work that we have to do the main job. So the academic research is very clear globally, by the way. This has been a global trend for more than the past 50 years. Advanced economies like the United States economy around the world all have central bank independence of one part or another, in one form or another. The other thing I'll add is that what comes with that, on our part, is an obligation to be highly transparent about what we do, to explain ourselves to the public, to Congress. Congress has oversight over the Federal Reserve in our system. So we spend a great deal of time talking to the oversight committees and the broader Congress in the House and the Senate, explaining to them why we're doing what we're doing. I testify as a matter of statute 2 times of the year in each of the House and Senate. So that kind of gives us the accountability that we need to be democratically legitimate in a situation where we do have some independence.
The macroeconomic conditions that you just described in your remarks sound tantalizingly close to a soft landing. I know you're not willing to declare victory yet. To what extent do you think the fact that the Federal Reserve is credibly independent is responsible for the good outcomes that we've had so far?
So the credibility is really everything in our work. And I think, as you know, inflation spiked really globally, all around the world, as the economies around the world reopened after the pandemic shut down, and on the back of a lot of fiscal and monetary stimulus. We saw a burst of inflation all around the world. And what happened is we raised interest rates to bring that down, but the public had faith. We measure inflation expectations many different ways, surveys and based on market-based instruments, and they all kind of showed the same thing, which is the public all through all this believed that we would get inflation down, that we would restore price stability, which we define as 2% inflation. And that's ultimately the key to it. Inflation is a social phenomenon. If people believe that inflation will be higher, then it probably will be. And if they believe that inflation will come down, then people who make and take prices and wages, they will make sure that it does come down. So it's absolutely critical that we be.
So the Fed is basically saying
inflation is a belief. We responded so forcefully when it became clear that inflation needed a response from.
let me turn it down. So essentially, what he's saying at the moment is that inflation, the prices of inflation can be affected by belief, right? Which is also an example of market sentiment, because if the sentiment is overall positive, then we should see, positivity surrounding that economy. But to say inflation can purely, or has a huge, or shall I say, to say that overall census has a huge impact on inflation, I don't think that's quite so accurate. I think inflation is just a very number, data, statistical based. Um, it's a very statistical based. What's the word I'm looking for? Based statistic or figure, right? Device, microphone. Yeah. Let's take a look at what he's saying. Let's have a listen.
So inflation is worst for people at the lower end of the income spectrum and the wealth spectrum. So we've seen it here in the United States in the 1970s, actually, and it's not a pretty picture. So, I think this is very widely, by the way, understood and supported. I've spent a lot of time on Capitol Hill, and I think
Literally,
it really
Giff,
matters,
this stuff you don't
both sides
listen,
of
or
Capitol
you
Hill,
don't
the
understand
Senate and the House,
until
and
you
both
actually
political
listen to
parties. There's a
these,
broad understanding that an independent
talks and
central
sit
bank
downs.
is
You
very
actually need to pay
important
attention to these
in
things.
just serving the public as best we can. We're not perfect. Everyone makes mistakes, but you'll get the best results if you have people who are just focused on that task and separate from politics.
Thanks. A little bit more elaboration from what we heard last week at the press conference on this question. In that press conference, you basically downplayed the impact of the election on FOMC policy. You said we needed to kind of wait and see, but that does stand in contrast to how the FOMC behaved at the December 2016 meeting, when roughly half of committee participants, according to the transcripts, upgraded their economic forecasts based on expected changes to fiscal policy under a Trump administration, and in particular a previous trifecta in which the Republicans controlled both chambers of Congress and the White House. You were, in fact, one of the policymakers who made changes to your forecast, finding that the staff's assumptions around a tax cut was a reasonable placeholder, which gave you greater confidence in the outlook. Does that approach seem reasonable in the current circumstances? That basically, since the FOMC has been starting to judge some downside risks to the growth outlook, does the election and the results that we have today remove or at least substantially mitigate downside risks to growth?
So that's your question? So I think it's too early to reach judgments here, and I'll tell you why. So the job of staff is to go, and be very nimble and make assessments in real time, much like capital markets do. The markets are pricing in assessments of what policy changes will be made and what their effect on the economy will be. And staff will do all of that. I think policymakers are going to wait longer to see what the actual effects will be. And so, for sure, at our December meeting, staff will present what we know. But the thing is, we don't actually really know what policies will be put in place. We know that policies in several areas will change. We don't know how much. We don't
Listen
know
to him stuttering.
When it comes to fiscal policy, it takes quite a long time to get a bill through Congress, and I think this year what we're looking at is something that doesn't need to get done until the end of the year, and therefore probably won't have any economic effects this year, but it'll be more 25. It'll be 26 or 27. So I think we have time to make assessments about what the net effects of policy changes will be on the economy before we react with policy. That's not to say we won't be doing quite a lot of analysis. And the analysis we do, by the way, is informed by the best research, the best thinking, the best experts, and there's a lot of research on the effect of policy changes on the economy. We'll make those assessments, but I think we'll be careful about changing policy until we have a lot more certainty.
You've spoken before about federal debt as being at unsustainable levels and the potential consequences for growth. do we get to a point where deficits and debt get so high that it makes your job harder, essentially, that makes it harder for the Fed to achieve its goals?
So we're not at that point now. I want to be clear that we're not in any way taking into account fiscal issues when we make our, let me say it this way. The debt issue is not an issue that is guiding us in making our economic judgments. Fiscal policy can, of course, affect the economy.
Where's my mouse?
You know, first of all, it's not, we do not have a role
dollar
of supervising
pushing
the
down a
elected
little bit.
branches that do fiscal policy.
Okay,
In
I
fact,
wouldn't
it's the other way
really,
around. So we don't
stress
give
too
them
much.
specific advice.
We've had quite an
But
aggressive run to the
as
upside.
I have often said, and
So
as all
if
of
we
my
are going to get a
predecessors
pullback, that's
have
perfectly
noted,
fine.
the U.S. federal
I
government
still like gold for a sell, but
budget
let's take a
is
look
on
at
an
how
unsustainable
much
path.
volume it
It's
has to
not
the
that
upside
the debt we have
first.
is at an unsustainable level. It's not. It's that we're on a path that's not going to be sustainable.
Because the thing is, we can even
we
come
have a
back
very
and
large
test
deficit at a time when
the
we're at
original
full
entry.
employment.
But let's see.
And I would just say, we know that we're going to need to address
Today does
that,
seem to be a
and
recovery
it's
day
going to
for
need to be
gold.
done
But
sooner or later, and sooner is better than later. But I leave
let's
it
see,
at that.
let's see, guys.
In addition to the potential
I swear,
long-term
I'm
risks
always,
that higher deficits
guys, I don't know
debt,
what it is, yeah.
present for
But as
growth,
soon as
are
I'm
there
doing
also
something, as
risks
soon
to
as
the
I'm
functionality
busy,
of the Treasury market?
everyone wants to
You know,
phone me.
when shocks hit the market, and if so, how might the Fed respond?
Everyone wants to
The
phone
functioning
me.
of the
This
Treasury
person wants
market
to
is
phone me. This
incredibly
person wants
important, and
this.
it does
Like,
function very well. It's the most
I wasn't
liquid,
busy an hour
and
ago,
most
2 hours
important,
ago.
Probably financial market in the world, certainly one of the most important. And so,
can we make this
you know, we did see
0,
some,
0?
at the beginning of the pandemic, you may remember
What would
that
that
the
do to
Treasury
it?
market,
0, 0.
lost function because
That makes it
normally
38.
in an emergency, money flies into the Treasury market, but the pandemic was such an unusual event. People didn't want to own longer-term securities. They only wanted to own effectively cash, and so we had to jump in and support that. I think more broadly than that, it's just important that that the Treasury market remain well regulated, and you know that that companies have an incentive to do intermediation in the Treasury market. It's relatively low risk. It's very important for the economy, and it's important that that be the case.
In the March 2020 episode that you're referring to, the Fed ultimately had to step in as a lender of last resort. Would the Fed do that if there were similar disruptions in the initial issuance of treasuries? That was in the secondary market, as I recall.
You know, we're not a fiscal actor, so that was a situation.
What are you guys
where,
doing at the moment? Are you buying, are you
we have a-
selling
we have a
gold, or
mandate
you're looking at
that
another
we
pair?
share with other agencies to look after the financial stability, and
Let me
part of
know.
that is if really important markets break down, and they kind of all broke down at the beginning of the pandemic. They just stopped working, and so we set up a series of facilities to backstop those markets, but they actually didn't get used because just the fact that we had the facilities restored credibility, and the markets started working on their own. It was remarkable. So in the case of a financial stability event like that, or
Right
the
now,
global
price is
financial
very
crisis, where
strong to the
really
upside.
the whole global financial system was at risk given the failure of a number of large financial institutions around the world. In those kinds of things, we can use these emergency tools, but they're not for every event. They're really for financial stability events.
You mentioned that it's a little bit too early to know what policy beyond the remit of the Fed would look like. You know, we don't know exactly what the fiscal picture will look like, but we do know directionally that tariffs are likely to go up, right? Even if we don't
Gold
know how
sell
much,
from
we don't know
25.71.
necessarily if it'll be exactly what was described on
25.71.
the campaign.
Oh, so you're already in the sell, yeah,
And I'm
Ritesh?
wondering how you're thinking about that. If you, well, go on, sorry.
So what matters for us is we don't stand in judgment over these policies in any way. What matters for us is to what extent will new policies have an effect on our mandate goals of maximum employment and price stability, and do we need to change our policy because of these changes in order to achieve those goals? And that's the answer to that question is not obvious. So let's say that there will be some tariffs. We have no idea what that's going to look like. That's one thing. Another thing is, what about retaliation? That changes the picture.
All right.
In
Even though
addition,
we're getting
that's
aggressive
happening
run
at a
up
time when there
on
could be
gold,
fiscal
I'm
policies,
still
which could be supportive of the
anticipating
economy.
a
So
short.
what's really the net
Okay.
effect? we don't
Still anticipating a short.
take one piece of
I'm
this. We're
anticipating the
looking at
dollar.
the whole
You know,
economy.
we've had
In
a
addition,
pretty
remember,
strong move
this
to the
is
upside,
way
so
over a $20
I'm
trillion
anticipating just a
economy.
pullback and a
Many
continuation
things affect the
eventually
economy
at
all
some
the
point.
time. It's not that common that changes in government policy have immediate effects in the achievement of our goals. That could
Early
be the
evening.
case, and of course
Okay,
we
okay.
will use our tools as we're supposed to do to foster the achievement of maximum employment and price stability. That's what we do. That's what we
All right,
always
the
do.
new 15-minute
And we'll
candle
do
just
it here.
opened. It's
I'm
looking
just saying,
okay.
we're going to be careful to wait and better understand the net effects of these things as those things affect the achievement of our goals.
If you look back to the previous round of trade wars under Trump's first term, the Fed staff prepared a report in the
We're going to try and
2018 table
hold
where
this
they
for a little bit longer
basically
if we
talked
can.
about whether the Fed should be looking through any price increases that result from tariffs and assume that they're, it's a one-time step up in prices as opposed to self-perpetuating inflation or not. And the staff said at the time that the Fed should look through the tariff increases so long as, one, you think it's going to be a one-time adjustment and not a series of adjustments, and two, so long as inflation expectations are anchored. It's not obvious that either of those conditions will hold the next time around, right? Back in 2018, we had decades of very low inflation. Now we've had a much more recent experience with higher inflation. And as you point out, there could be a series of retaliations and tariffs.
That's a pretty
and
nice push there
counter-tariffs
from
and
the dollar.
counter-tariffs. So are the risks bigger this time that a price shock could feed into trend inflation?
They're different. We're in a different situation. The debt situation has changed substantially. And you're right, we're not, 6 years ago and such, the inflation was really low and inflation expectations were low. Now we've come way back down, but we're not back where we were. It's a different situation.
Nice price action there from the dollar.
Above 2%. But we'll take all of that into account. I tell you though, the answer isn't obvious until we see the actual policies, and even then
I'm in on gold.
So I just think we reserve judgment until we actually know what we're talking about. And I don't want to speculate. I don't want to guess. I think it's more important that we wait and see what actually happens.
Last time around, as you suggested, there were mixed consequences. There were mixed effects. And as I recall,
To be honest,
during these previous trade wars, the Fed actually cut rates several times
hit
because there
TP1
were
very quickly.
consequences for growth and investment and confidence.
To be honest,
So how does
I reckon
the Fed
this can
respond
probably give us one more
if
test of the entry
higher tariffs result in
before
both
really
higher prices
dropping
and
lower.
slower growth? Do you have the tools to
Right.
respond
I
to that?
reckon.
Well, so you're absolutely right. So in 2000 and I guess it was 19, we cut rates 3 times, and that was right after there had been fiscal stimulus, there had been tariffs, and so it really was because the net effect of what was happening, and of what was happening around the world too. There was global growth was really soft. There was a feeling that the U.S. economy was softening. We actually cut rates 3 times, I guess beginning in mid-year, and that kind of worked. That restored confidence. We felt at the end of 2019, we felt like that had really worked, and that situation was quite a good one. Of course, then the pandemic arrived, and none of it mattered. So that's the way it happened. But that's exactly my point, though. We had a meeting the prior December, and it briefed us on what might happen. But what actually happened was something quite different.
Ritesh, your sell there should be in profit.
I just mean the way that played out. I don't think we started that year thinking that it would be appropriate to cut rates 3 times. So just know that we will do what we believe is the right thing. That's what we're always going to do. But I think it's really important to reserve judgment and see how this plays out. We're still months away from a new administration, let alone knowing the real details of what's going to happen, and then being able to project what will be the net effects on the economy.
Another major factor in the economy in the past year or so, you've said, is immigration. That immigration is a strong reason why supply and demand have gotten closer into alignment. In the past few months, we've already seen big decreases in immigration. What effect do you think that is likely to have on the macroeconomy in the near term?
So before I answer that, I do want to say that immigration is a question to be addressed by political authorities using such values as they
Yeah,
deem
this thing is
appropriate,
going.
not, we're
not
looking
pulling
at
back.
macroeconomic effects
I wasn't even able
and
to send it
reporting
in.
on them. We're not, it's not a question of judging. We don't have a view on the right level of immigration. That is for the voting public and their elected representatives. Okay, but what we saw over 2023 and 24 was a surge in immigration, and also a surge in the labor force, and it certainly pushed up economic growth, and it may or may not have had some effect on getting the labor market back into balance. It'll take time to really understand that, but it certainly made for a bigger economy. And we're coming off the back of a severe labor shortage, so there was room at that time for people to get work, and they went to work at roughly the same level as non-immigrants went to work. So that happened. Then the rules changed. The current administration, the Biden administration, changed the rules a few months back, and we've seen that come down. These are judgments that get to be made by elected people about what the right thing for the country as a whole is, not by us. But you ask what the effects will be. You will see. Really, there have been two supply-side things.
That's TP2 here, guys.
U.S. potential output and actual output. One of them is just more workers, and the other one is productivity. And the more workers part of it is probably diminishing in its effects, and so that won't be something that's pushing up overall output. Things has come way down, so it's not clear what the overall effect will be on there's about one job opening for every unemployed person now. In terms of productivity is incredibly important. That's just output per hour.
Okay, guys.
And if you think about it, higher output per hour is
Dollar
really
looks like it's going to continue.
the only way for incomes to go up over time among the public.
Obviously,
And
I
we've
appreciate you
actually
guys that are
had,
on the live stream right
for
now.
the first time in a while,
You're receiving
a
this
few years
signal
of higher
live.
productivity,
Well,
going back
I wouldn't
5
say
years
signal,
now.
this trade idea
This is
live,
incredibly
right?
important and very positive.
You're
and
receiving
we
this
hope
live
it-
with me.
we
You're
hope it
watching me work,
continues.
guys. You're watching me work. You're watching me
And
work.
there's no reason
I
why it
called out
can't.
this
I
move
will
way
say,
before it
though,
happened. I posted a
over the
chart
past
inside of the
50 years,
Telegram
if you look at
for
it,
the people
if
that,
you have 1 or 2 or 3 years of
don't want my,
productivity, it tends
don't
to
want to pay
revert
for
to
my
the trend really
services, but it's
quickly.
all good.
Because it
You
tends
know,
to be
I'm
driven
paying
by
you
longer
guys
run
that are
things
on the
like
live
evolving
stream. I'm giving back to
technology
you guys
and evolving
by showing
educational
you
levels and
what I'm
things like
sending
that. So it
in the
doesn't-
other
you don't tend
group.
to get
Do you understand what I'm saying? So if
big
you are
increases
on these
of
live streams,
productivity that
you
are
will receive them as
sustained
well.
very often. It's
Bro,
quite
40
rare,
pips
but
down
it
already.
does happen.
I do
Already.
want to ask you some more questions about productivity, but just one follow-up on the immigration
Who's in
point.
this?
So economic growth is about the size of the workforce and how productive that workforce is. I asked before about the consequences of decelerating
TP2's just been
immigration.
hit.
What
over 40
happens
pips.
if the workforce actually shrinks? As a
TP2
result of,
was
For example, mass
25,
deportations,
6,
which may be
7.5,
more often.
and the low. So I'm looking
not
over
gonna
here.
be comfortable speculating.
So you
on
got open,
potential
high,
policies.
low,
I-
close
It's not our job
of the
to be a
candles. Yeah. So
commentator
the low of this
on-
No,
candle
I'm not
is
asking whether it's good or bad. I'm
25,
just
6,
asking,
7.22.
what does it mean if the workforce shrinks?
So TP2's been
You
hit.
know, I mean, I think we can do the arithmetic. If there are fewer workers, there'll be less work done. But we don't. It gets too close to, I just don't want to go there. This is getting me into into political issues that I really want to stay as far away from it as I possibly can.
All right, so let's talk about productivity. You're right that productivity has been above trend. I think 8 out of the last 9 quarters GDP growth has been above trend, largely because of productivity. To what do you attribute that?
So this is something people will be arguing about in decades from now, but I would give you 4 or 5 candidates. So one of them is that in the pandemic, people started a lot of businesses, and that many of those fail fairly quickly, or don't turn out to matter. But when there's a burst of activity in starting businesses, there are tens.
All right, so we're getting a little bit of a
higher
pullback now.
productivity, because many of these are technologically driven, or the use of technology is
Let's see
is
how
pushed
aggressive
out
it's going
into
to be.
society. So that's one. Another is that unlike a lot of our, for example,
Like-
European countries. where they kept the
Suspecting, I'm
labor force
speculating
in
that it's going
place.
to hold here,
Here,
and we're
people
going to get
had
a
money
move
from
down lower.
government transfers and also from
Right,
forced
the dollar is
savings. They
having a
couldn't
bit of
travel,
an
they couldn't go to
aggressive
restaurants.
pullback. That's fine.
And so they quit their jobs and they went and found other jobs. And so there was this huge reallocation of people
This
from
might just be a
jobs
re-entry,
that,
guys.
that they actually didn't want that much to jobs that they wanted more. And that's a real, we think that's a real factor in this. In addition, given the tremendous labor shortages, a lot of time and effort went into supplementing and, people's technological capabilities in ways that substituted for labor. So there's a lot of
That daily candle
Can
on
you give an
gold
example
looks
of
very
what you mean?
dangerous. I'll be honest
Sure.
with you.
I mean, just
The
just
daily
call
candle gold
centers,
does not
there's
look
lots of
conducive
ways
for a
to,
short. It doesn't.
You can now do call centers.
That daily
they're
candle on
much
gold does
more
look like it
automated.
can
We're
push
getting
up
to a
higher,
place
but
where call centers
let's
will
just
be
wait.
done by artificial intelligence, probably. But also just, you go to a fast food restaurant, which of course I never do anymore at my age. But if you go to, I'm told, if you go to a fast food restaurant, a lot of that is, and I've seen this in airports actually, you don't necessarily need somebody to take your order. You've got a nice menu, you punch a screen and the food appears. So, and there was tremendous incentive to do that when there weren't any workers. I mean, you saw stores that didn't have very many people in them and that sort of thing. So I think that's an example that we saw.
I don't think I heard you mention in that response anything about like generative AI. I'm wondering,
Bitcoin's
do
ranging,
you
guys.
think that could be part of a new era of productivity acceleration?
Artificial intelligence, pre-generative AI, is used all the time by big companies and modest-sized companies too, and it's certainly having an effect on
S&P's dropping.
productivity. Generative AI is just in the early stages, and certainly the companies and the banks in particular that we deal with are
be
not
honest,
really using it yet. They're
I'm
not
looking
really
at another
deploying it yet, and
re-entry.
they're very aware of the risks in it.
Right here.
So, but over time, I mean, you can find estimates from credible organizations that generative AI will create a burst of productivity, a large burst of productivity in the next decade. You can also find skeptics, very credible skeptics who think that that's hugely overdone. The history has always been that, there's innovation, there's technology, it doesn't show up in the productivity statistics at all, and then it shows up a lot, but much later. So it's usually later and bigger than we expect. That may be the case here, because this really, it is an extraordinary
Gold's moving,
set
man.
of developments. And
We are
the
absolutely
ability to replace
literally
a lot
predicting
of,
gold to the
of
T.
work that's currently done by humans, including
We're predicting gold to the T, guys.
humans,
You're watching me do
is
this live.
obvious.
I don't know who you're
How does
seeing
that influence your
do
thinking
this
about
live.
monetary policy?
Whether win
It really
or
doesn't in the
lose,
short term.
you
We
guys
keep
see me do
extremely
this live.
close tabs on
I
the
don't
labor force.
sugarcoat
If you think
anything.
about it, monetary
I'm here with
policy
you.
is
You're
trying to
watching
move,
me.
trying to
There's nowhere for me to hide.
the economy at maximum employment and price stability. Trying to use our tools to
The
do
only
that.
problem is sometimes I wish I
That's
had
a
an
you're
assistant to
thinking,
like punch in the numbers for me
2 or
quickly
3 years
because
out. The kind of things that
it's,
drive
it can be
longer
very
run
difficult.
productivity and that matter for the longer run are really not tools that are in our hands. The best thing we can do for technological evolution is to create macroeconomic price stability, by which I mean price stability and a good, strong, stable labor market so that people don't have to worry about inflation, volatile or high. And so that's the most that we can do, I think, best thing we can do.
You mentioned that a lot of the financial institutions that you regulate or you oversee are also experimenting with these new technologies, with AI. Given that so much AI is not explainable, it's sort of a black box, a lot of the time the software engineers or others who work with it cannot explain how it came to the decision that it did. Does that make it harder to regulate?
That's
in the
very
sense
true
that
about AI. That's a very
there might be
interesting
blind
topic,
spots
actually.
for certain kinds of systemic risk, right? If banks don't necessarily know
I hope you're hearing
how they're coming
what
to-
the
to
lady's saying in the
decisions
back.
that they're
Those
coming
are very
to,
good
and
questions.
There could be some hurting that may not be obvious ex ante.
It raises just that kind of question, many different questions like that. I would say the good news is, in terms of the institutions we supervise, we understand that, but they understand it very well. I think people are treating AI very carefully, and they're not just loosing it, at least among the regulated banks, they're not just loosing it on their customers and on the problems they face. They're being very careful and thoughtful, we believe, or at least I
That's a
believe,
great
about,
question, isn't it, Gift?
about how they implement it, doing lots of work, but they're keeping it carefully under wraps and not deploying it so much yet in their business. And working, everyone's working to understand the technology, where it's going, what it's capable of, what the risks are. And you mentioned that. It's making decisions, and we often don't know why it makes these decisions. So how do you get after things like discriminatory outcomes in lending if you don't know why it's making its decisions? So it's going to be challenging, but I would say we're well aware of that, and so are the banks.
You have a 5-year strategic review coming up. How has your experience over the last 5 years made you reevaluate, if at all, the strategy adopted in 2020?
We had a strategic review, and we have a document called our Statement on Longer Run Goals and Monetary Policy Strategy. It's 1 page. The type is getting really small, so I think we're going to go to 2 pages next time. But we were remember that was the era where for a long time after the global financial crisis, rates around the world were incredibly low. For example, major European countries, their longer-term debt was yielding negative 30 basis points and things like that. How do you even understand that? So rates were very, very, very low in the economy, and that's a problem for central banks because we can't cut rates meaningfully below zero, and cutting rates is what we do to support the economy. So we actually like having significantly positive interest rates like we do now. All right, so what we did is we said there was a whole literature on how you deal with, in monetary policy, how you deal with having interest rates stuck at zero in effect, and you can't cut, you're kind of stuck, you can't support the economy, you get into this trap where growth is low, inflation is low, unemployment is high, and you can't get out of it without fiscal policy, and fiscal policy is challenged. So there was a lot of research done on it, and we took a pretty mainstream, fairly vanilla approach to that, which is, I won't go into all the details, but it was to have a make-up strategy so that we would promise ex ante to let inflation run a little bit high if it were running too low. And the thought was, if people believe that you'll do that, if that's credible, then inflation won't run low. So that's all we did. 4 months after we announced that the pandemic hit, and then inflation a year after that came up. So the change, 20 years of low inflation ended sort of 4 months or a year and 4 months after we did the framework. So the question we'll be asking in this framework 5 years later is really it revolves around how do we think about the problem of the zero lower bound now? Now that interest rates are substantially higher than they were, substantially higher. Is that going to be so the question you're asking is, do we, in a world where we review the framework every 5 years, shouldn't we change the framework to reflect that interest rates are higher now so that some of the changes we made are probably not necessary, or in any case shouldn't be the base case anymore? They might be a case that we can have that remedy at the handy, but at the same time, the base case should be more like a traditional reaction function where you don't promise an overshoot, you just target inflation. We haven't made any decisions, but those are the questions we'll be asking.
You mentioned the prospect of long-term rates being higher, the neutral rate being higher. You've said many times when asked by journalists, among others, about how we know when we've hit the neutral rate, that we know it by its works,
yeah.
Right? Which almost sounds like ecclesiastical or something. How long does it take to evaluate whether we've hit it? When do we know? If there are lags between the time.
Okay,
that we hit
guys,
the
I just
neutral
got off the
rate
phone.
and that we can
I need to
see
go.
it in its works,
But
does that
I've sent
increase
this
the risk for policy
this setup inside of the Telegram.
Let me just take a second and explain.
So
we move interest
we
rates
can,
up and down, but what is
monitor
high and
these
what is
moves
low?
as they are.
Compared to
doing
what
their
is
thing.
the question? You have to have.
So we'll come
an
back to this
estimate
later.
of
I'll update you
something that's
guys
kind of
accordingly
neutral,
inside
something
the
that
Telegram.
the level of interest
And
rates
again,
that's
thank you
neither
guys
pushing the
for joining
economy
me.
up,
Obviously, for the likes of Gift,
supporting it,
Ritesh.
or dragging it down, which would be higher restrictive
I don't know who else
policy.
is in here. Jennifer,
And
obviously, you
we
guys have been
fully
able to
acknowledge that there's no
take
sort
advantage of this
either
move here as
theoretical
well.
or
So,
empirical way to
yeah, I'll
arrive
see you
at an
guys.
estimate
I
of
probably
what
won't
the
stream
neutral
tomorrow,
rate
to be
is
honest with
that
you,
you can
but
really
we'll
have
see.
a lot of confidence
If
in.
there's some moves, I might do it. if
What
a
does
lot
that
of you
argue
guys
for?
ask me
It
for a
argues for
stream,
moving carefully.
I
So
might
in
do
our
it. You know. But yeah, other than that, guys, Money Day, and I will see you guys later.